Good morning. I'm Alan Harris, CEO and Chief Investment Officer of Berkshire Money Management. Although I guess I don't really know if you're watching this or listening to this at morning or not. It's morning here. It's what is it? 6 a.m. 5:57. So I don't typically talk about individual stocks. Individual companies, yes, but not individual stocks. But the stock I talk about most is Nvidia. I mean, it's in the zeitgeist. It's the business world and the economy seems to be circling around it and the things that it does and builds for the world. They're the designer of GPUs, graphics processing units, and GPUs are processors used by large language models or LLMs because they're really good at performing the same operations on multiple data sets. It's called parallel processing. So if you're not sure what an LLM is, think chat GPT. It's usually what people mean when they say artificial intelligence. Artificial intelligence is much more than that. But yeah, GPUs are needed for AI, including LLMs. So after the market closed on Wednesday, which was November 19th, NVIDIA reported, quite frankly, just blockbuster earnings and great guidance. I think that's just objectively true. Going into the earnings release, the stock was down at 12% from its recent high, and as were many other stocks and some indices, but stocks in particular associated with AI. There's been a lot of framing lately about AI bubble is deflating. Everyone's concerned, so there's been profit taking, selling in that area. Okay, so the next day, on November 20th, after NVIDIA released earnings, stock was up like 5%. I mean, it was a gangbuster morning for the stock, and it pulled up the whole stock market for the most part. And then it reversed. I mean, like big time and pretty quickly. I mean, later that morning, NVIDIA went from like up 5% to down 3%. It finished a little higher, but still, what a heck of a reversal. And the stock market followed the same trajectory. And a big question on the minds of investors was that a signal that the stock market was going to drop and turning? Because the others, Bell, can you see her? If I move, you can see her. Bell, baby, what are you looking at? Here she is. All right, so was that big reversal a drop? I'm sorry, was a big drop, but was that big reversal a signal that the stock market is going to drop further? Well, I guess first, let me acknowledge that, or even more so, throw darts in the direction of myself specifically and everyone else reports on the market. And basically, anybody who follows a stock and sees a price goes up and down and then acts on it or talks about it, I mean, narrative almost always follows price action. In other words, something happens, and then we piece together a puzzle and tell a story to explain it. And that's not to say market pundits only know things in hindsight. It's actually worse than that. We make stuff up in hindsight, and that's a very human phenomenon. It goes beyond my industry. We all do it, whether we're conscious of it or not. We just don't all recognize that we do it. But it is my job to identify biases and subconscious drifts. And that being said, I think that these possible reasons for that massive drop in NVIDIA stock itself and the stock market as a whole are logical reasons. Okay, first, there was a tweet or X from President Trump about killing Democrats that could change things. But second, there's Oracle. Oracle, it's a company that's right in the middle of the AI ecosystem. And the spread on what's called credit default swaps, so I'll get to that in a second, but there's some interest rates associated with it. So the spread on Oracle credit default swaps rose, and it rose at a bad time in the sense that there's already been a lot of skepticism surrounding the valuation of AI-related companies and circular funding and can it continue? So I won't drag you into the weeds on credit default swaps, also known as CDSs, but they're a financial derivative, and it kind of acts like an insurance policy on a loan or a bond. And if the spread widens, what that means is a rate increases relative to something else, like a treasury bond. Because if something moves by itself, if something moves independently, it can be more meaningful than if it moves in relation to something else. So that spread. And it's a signal when the CDS spread of Oracle rose, because it signaled that investors might be concerned about something else, like the company's creditworthiness. There's a massive inventory spend or capital expenditure spend out there by these AI-related companies. And for the most part, it's cash outlays, not debt. But Oracle is a company that is using some debt. In part, not because they are low on cash, but they spent the last 15 years like really aggressively buying back their own stock. And I don't want to say the cash trap, but they used up a lot of their own cash to inflate their stock price. Inflate might not be too cynical of a term. But anyways, that's one of the things that happened that possibly explains why NVIDIA stock in the market were up, and then it went down over a lot. Big reversal. Third, cryptocurrency, well, as a whole, has been crashing. It's down about 30%. Well, Bitcoin specifically is down about 30%, maybe 27. In about a month and a half. So 30% drop in a month and a half that's a lot. I mean, I don't want to go through that. And so some investors are seeing that as a red flag, and so they wanted to de-risk. But I think it's more than that. I think it's more than like, okay, it's don't like this phrasing, but canary in a coal mine, but it's everyone gets the idiom. Excuse me. But in particular, on that day, there was a stable coin, and a stable coin is a cryptocurrency, but it's meant to not fluctuate in dollar. You think about a money market. You've got a money market, and it's always $1. If for some reason someday it goes to 99 cents, it means there's some severe stress out there. You don't see your money market go from $1 to 99 cents, and when it does, you're going to read about it in the Wall Street Journal. It's kind of a big deal. Well, the stable coin, again, is supposed to be 1-1 peg, and this time against the US dollar, went down to 65 cents. Yeah, 65 cents. I just said if a money market went from $1 to 99 cents, that's going to be in the Wall Street Journal, going to be a big deal. This stable coin went from $1 to 65 cents. So the air quote good news on that, though, is a price deviation. I want to again emphasize air quotes because this wasn't good news. But the good news was that it briefly went down because of an error. There's a coding error. I'm not going to get into the details of it and the way these things are priced in different exchanges, because I think I'd be dragging too much into the weeds. But that coding error triggered this automated deleveraging mechanism, which essentially says, you've got something that's going up and it's volatile, and you're buying it in leverage, and if it goes down as a trigger, we're going to sell things because it's way too risky. So if your equity falls below a certain threshold, automatically we're going to sell some things because it's leveraged, and it's an automated deleveraging mechanism. Well, that resulted in 2 million crypto accounts being liquidated, even though a minute before, there were most of them were in the positive. So after the flash crashed, boom, they were all sold. And that was enough to move the market. And I hesitate there because I want to get into this briefly. I don't spend too much time on it. Cryptocurrency is not as uncorrelated as some people would hope that it is to the stock market. There seems to be a fairly great high degree of correlation, and in particular to the Nasdaq. So when you saw a big shakeup in the crypto market after it had already been down significantly over the last month and a half, that was probably another reason why the market was up a lot and then went down a lot. Okay, so although I feel like these were all logical reasons, not they're not things I want to see happen, but they're logical reasons that the stock market had a reversal on that day. I still think there could be some more downside to come. So let's examine the Nasdaq specifically and some of its history. In the Nasdaq, because there's all this talk about an AI bubble, and is it deflating? And I don't think that it is. I mean, it's an alleged bubble, as I've been saying. There's a bubble and talking about bubbles, specifically when it comes to artificial intelligence. So the Nasdaq is down about 8% right now from its recent high, and it's the 26th time that the Nasdaq has had a 5% plus correction from the lows of the great financial crisis. As you'll recall, it was in 2009. So what is that? Like almost 5% pullbacks per calendar year. Like maybe it's 2 every 14 months or something like that. So it's pretty common. And we always freak out about it when it happens. The collective royal we. But this time it seems more so than usual, just because there's all this talk about an AI bubble. So I don't believe that there is an AI bubble that's deflating. So I'm going to rely a little bit on history. And if you're new to anything I say or watching stuff that I put out, I've covered this a lot. So you can go back and see some of the other stuff. I won't go into other reasons now I don't think it's an AI bubble. So putting that aside, yeah, I think history probably will paint a fairly good picture of how the remainder of this Nasdaq correction plays out. So, like I said, it's down about 8%, and that's in 18 trading days from its recent high to its recent low. And I'm recording this on Saturday, the 22nd. Yeah, so give you some context of those 18 days. However, the average decline happens over 43 days. So that puts us in late December, and the average decline for Nasdaq once it gets over 5% is 12.5%, which isn't the end of the world, but still it's not something that I want to go through. I should say that's the average. The median is let me just pull this up. I think I have this. Maybe specific for you. I've got some data. This is courtesy of Bespoke and their great work. So the median is I should write this stuff down. I don't want to write it down though. I just want to talk freely. Median is 20 days. So that would put us at what, Tuesday, I guess, for the end for the median duration of a 5% plus pullback in the Nasdaq. And the median correction is 9.7%. 8% so far, 9.7%, pretty close. So, I mean, we could be about done, really. Still, I don't think that this is a deflating AI bubble, like I said. So those historical contexts, I think, are reasonable. And I think that the average that you said, another, call it 4 or 5% decline in the Nasdaq over the next month is the most probable worst case scenario, and maybe even the most probable scenario. I think that the second most probable scenario is that it's pretty much done, and was done on November 20th specifically, because the VIX, also known as the fear gauge, it spiked above 28.27 to be specific, because there are some things that are specific that are important here. And I'd be more comfortable if it closed above 27.31, maybe it's 3.4, but something like that. Sometimes I'm a better librarian than a library, because I can look things up as I'm chatting freely. Because that would be one standard deviation if the VIX closed at 27.31. There'd be one standard deviation above its long-term average, and so that would be a signal that the bottom was more likely in. But anyways, those are the two scenarios I think are most likely. So either scenario is good enough for me to maintain my equity position in my portfolios, at least for now. That's all I got for today. There's probably a lot. Have a great day. I'll talk to you next week.